If you're a real estate investor, especially in a high-tax state like New York or California, you've probably heard this number, $40,000. Starting in 2025, the SALT deduction cap increases from $10,000 to $40,000. And a lot of people heard that and thought, finally, I get to deduct more. Finally, some relief. Finally, Washington fixed it. But here's the uncomfortable question. Is that $40,000 actually yours? Because here's what most headlines didn't say clearly, that $40,000 isn't automatic. It isn't guaranteed. And for some investors, it changes absolutely nothing. If your income is over $500,000, your deduction may start shrinking. If your income is high enough, you may still only get $10,000. If most of your taxes come from rental properties, you may have never been limited in the first place. So today, we're not reacting to headlines. We're stress testing the rule. Because the real question isn't, did the cap increase? The real question is, were you ever inside the cap in the first place?
Hold on, I live in New York. My primary home property tax is $28,000. State income tax is about $32,000. That's $60,000 total. So I can deduct $40,000 now, right?
On paper, maybe. In reality, there are 3 gates you have to walk through. If you don't pass all 3, you don't get the $40,000. And most people don't even realize these gates exist. Let's break them down carefully. First question, are you even itemizing? For 2025, the standard deduction is $31,500 for married filing jointly, $15,750 for single, $23,625 for head of household. For 2026, $32,200 for married, $16,100 for single, $24,150 HOH. Now pause here. If you're married filing jointly, your itemized deductions must exceed $31,500 before SALT even matters. If they don't, you take the standard deduction. End of story.
So if my total itemized deductions are only $28,000, this entire conversation doesn't apply to me?
Correct. You never entered the game. And this is where a lot of investors get tripped up. They react emotionally to policy changes without checking their own return. Last year, did you itemize? Did your CPA use Schedule A? Or did you default to the standard deduction? If you don't know, there's a good chance SALT never affected you. And here's something important. The higher the standard deduction goes, the fewer households itemize, which means the SALT cap increase may benefit fewer people than expected. Gate number 1, you must itemize. Now we move to the second gate. And this is the big one for real estate investors. A lot of investors say, my property taxes are huge. But here's the question, which property? Rental property taxes are reported on Schedule E. They are business expenses. They reduce rental income directly. They were never subject to the $10,000 SALT cap. Let me say that again, rental property taxes were never capped. The SALT cap applies to state income tax property tax on your primary residence property tax on a second home, not your rentals.
Wait, so if 80% of my property taxes come from rentals, I was never capped?
Exactly. And this is one of the biggest misconceptions in real estate tax conversations. Investors say, my property taxes are killing me. But if they're rental taxes, they were already fully deductible. If your tax frustration has been coming from rental losses, passive activity limits, depreciation timing, basis limitations, SALT was never the issue. This is primarily a homeowner plus high state income tax issue, not a leveraged rental investor issue. Gate number 2, where does the tax live? Schedule A or Schedule E? Now we get to the part that surprises high earners. Starting in 2025, if your MAGI exceeds $500,000, your SALT deduction gets reduced. The reduction equals 30% of the amount your income exceeds the threshold. Threshold schedule, 2025, $500,000. 2026, $505,000. 2027, $510,050. 2028, $515,151. 2029, $520,320. But no matter what, you can't go below $10,000. Let's use real numbers. If your MAGI is $570,000, you exceed by $70,000. 30% times $70,000 equals $21,000 reduction. $40,000 minus $21,000 equals $19,000. You don't get $40,000. you get $19,000. If your income is $700,000, you exceed by $200,000. 30% times $200,000 equals $60,000. Your deduction collapses to $10,000.
So higher income doesn't mean bigger deduction?
Correct. In this case, higher income can shrink your benefit. Now here's where planning comes in. If you're near the $500,000 threshold, income timing matters. Capital gain timing matters. K-1 distributions matter. Bonus income timing matters. Retirement contributions matter. Crossing that line is not just psychological, it's mathematical. Let's define MAGI clearly. MAGI starts with your adjusted gross income. Your AGI is on Form 1040, line 11. Then certain adjustments are added back. If you're a real estate investor, your MAGI might include capital gains from property sales, K-1 pass-through income, consulting income, side business income, portfolio income. That number determines whether your deduction gets reduced. And here's the subtle risk. You might feel like you're around $480,000, but after capital gains, you might be over $500,000. That's where surprise phase-outs happen. Not all real estate investors are affected the same way. Category 1, mostly rental income, moderate AGI, likely minimal SALT impact. Category 2, high primary residence property tax plus strong W-2 or business income, potential beneficiary. Category 3, high-income investor with large capital gains or multiple income streams, likely phase down to $10,000. Same policy, 3 different outcomes. Policy is simple, tax structure is not. This increase is temporary, 2025 through 2029. In 2030, the cap returns to $10,000. That matters. If you're planning a property sale, a large capital gain year, a liquidity event, a business exit, timing may matter more than the cap itself. Tax law isn't just about how much. It's about when. 5-year windows create planning opportunities, but only if you know you qualify. Pause for a second. If you're a real estate investor, did you itemize last year? How much was your primary residence property tax? What was your AGI? Were you over $500,000? If you don't know those numbers, you're reacting to headlines, not analyzing structure. And that's normal. But structure is where control lives. Let's summarize clearly. 3 gates determine your SALT outcome. Number 1, itemized versus standard. Number 2, Schedule A versus Schedule E. Number 3, income phase out. The cap is simple. The structure is layered. And here's the bigger truth. Sometimes paying more tax isn't about compliance. It's about peace of mind. Understanding the system reduces risk. Chasing headlines creates noise. Before we close, this video is for educational purposes only. It is not tax, legal, or financial advice. Every investor's situation is different. Income structure, filing status, and state residency all affect how these rules apply. Please consult a licensed tax professional regarding your specific situation before making decisions. If you're a real estate investor in a high-tax state, comment one word, itemize or standard. Let's see how many of you are even inside the rule. And if you want structured breakdowns like this, not hype, not politics, not fear, just tax mechanics explained calmly, subscribe, because tax law rewards people who understand timing, structure, and thresholds. And we're going to keep breaking this down clearly and carefully.